Good morning, everyone, and thank you for joining us today. I'm Kathy Fitzmaurice from the Central Office, and I'll be your host for today's webinar, Equity Crowdfunding. Your microphones and telephones are currently muted to eliminate background noise during the presentation. We will take questions at the end. To ask a question, either type it into the question box on your control panel, or if you have a working microphone, raise your hand by clicking on the hand icon and I'll unmute you. Today's program is being recorded and will be available through WebMQS in the Shared Resources section. I'd like to thank our Stony Brook SBDC for arranging this webinar. So let's go ahead and get started. I'm very pleased to introduce Alon Kapen, a partner at the law firm Farrell Fritz in Uniondale, New York. Welcome, Alon.
Well, great to be here. Thank you very much, Kathy. Just a quick introduction of my own. As Kathy said, I am a partner at the law firm of Farrell Fritz, a Long Island-based broad practice firm. I'm a partner in the corporate practice group, and I also head up our emerging companies and venture capital practice group, where we represent entrepreneurs, startups, emerging companies, and the investors who invest in them, venture capital firms and angel investors. And welcome everyone to this webinar. I'm delighted to be presenting, and it's a great time to be talking about equity crowdfunding under Title III of the Jobs Act, because it's just less than a month ago that the new rules under Title III of the Jobs Act went live. And now, for the first time, companies can raise up to $1 million in any 12-month period online from anyone, not just accredited investors, and without registering with the SEC. This is truly historic and potentially disruptive. It's historic because it upends an 80-year ban on publicly offering securities without registering with the SEC. And it's potentially disruptive because the SEC estimates that non-accredited investors make up approximately 93% of the U.S. population. And it's also estimated that that 93% of the U.S. population has about $30 trillion socked away in investment or savings accounts. So just to put that in perspective, if only 1% of that $30 trillion got allocated to equity crowdfunding, the resulting $300 billion market in equity crowdfunding would be 10 times as large as the current VC market. VCs on an annual basis invest approximately $30 billion in startups and emerging companies. So the new rules with respect to equity crowdfunding that went into effect a month ago are very complex. They're somewhat restrictive, and it would help to understand them if we got some context and understood where equity crowdfunding came from. So this is the agenda for the presentation today. I'll discuss what exactly is crowdfunding in its various flavors, where it came from, talk about non-equity crowdfunding as the origin of equity crowdfunding. We'll talk about what prevented companies from doing this before. We'll talk about the historical impediments to raising capital. We'll talk about the alternatives to Title III equity crowdfunding. There are a couple of different forms of equity crowdfunding already in existence, and when I refer to crowdfunding, I'm referring to the generic sense of the term, meaning the effort to raise funds online from many, many people, each contributing small amounts. We'll then we'll get into the weeds of Title III crowdfunding, and then we'll finish up by talking about reform efforts that are underway to fix some of the perceived defects in Title III. So let's jump right into it. So what is crowdfunding? Essentially, it's the use of the internet and social media to raise funds from many people, each making small contributions. And as I mentioned, it really originated with non-equity crowdfunding. And there are three different flavors of non-equity crowdfunding. The first being donation-based. In the donation-based model, backers simply make donations to not-for-profits, sometimes to individuals who have major medical issues, for example, with nothing in return. No reward, certainly no security, no stock or anything like that. These are three different forms of non-equity crowdfunding that have been very successful. The second type that has been successful in the last several years is rewards-based non-equity crowdfunding. In this model, again, no stock, but the backers, the supporters, the contributors receive some token of appreciation in return for their contribution, like a T-shirt, a mention in a book that's being written, a credit in a film, that sort of thing. And then finally, there's the pre-order variety of non-equity crowdfunding, which is essentially the pre-sale of products by a company that's developing the particular product. And in this model, backers who are interested in what's being produced will contribute, and if they contribute above a certain amount of money, they will receive the product when it's produced, usually at a discount, and there's no guarantee that the product will ever be produced. But when it is produced, the backer or the contributor will receive that product. So here are a couple of examples of non-equity crowdfunding. This is a GoFundMe campaign that just started a couple of days ago in reaction to the horrific terrorism mass shooting in Orlando. So this is to help support victims and their families, pay for funeral and medical expenses. It's raised more than $3.8 million in just the 2 days since the attack. And it makes it the fastest growing and largest campaign in the 6-year history of GoFundMe. But not every crowdfunding campaign is socially worthy, as you see from this campaign. This has to do with Arizona Cardinals quarterback Carson, who was hit with a fine of $11,000 for making an obscene gesture with his pelvis towards a hostile crowd. And a local radio station in Arizona started a campaign to raise money to pay for his fine. As you can see here, they sought to raise the $11,000. They were only able to raise $2,200 of it from 200 people. Here's an example of a pre-order variety of a non-equity crowdfunding. This is probably, it was the most successful campaign on Kickstarter at the time, and it remains one of the largest campaigns ever. This is a smartwatch company that was looking to finance the production of its smartwatch, and what it offered backers is anybody who contributed at least $115 would receive the smartwatch, which was going to retail for $150 when that smartwatch was ready. The amazing thing here is that their target was $100,000. They were looking to raise $100,000. They hit their goal within 2 hours. And when the campaign was finished a month later, they had raised over $10 million from over 68,000 backers, which is pretty remarkable. So pre-order based non-equity crowdfunding campaigns are a great way for a company to raise funds, but they're much more limiting financially than equity crowdfunding, because you're essentially just pre-selling the product at a discount and you're netting less than in a true capital raise. But by by engaging in a pre-order-based crowdfunding campaign, instead of selling securities, you could avoid diluting the equity of the existing stockholders, and you could also test the market demand for your products before committing to produce them in large quantities. So as you see, non-equity crowdfunding has essentially focused on projects like artistic works, community service, product development, and for items with a sufficiently high, what I call, coolness factor. That coolness factor is necessary to be able to draw donors despite the lack of financial gain to the contributor. But of course, not every business model lends itself to that, and so a rewards or pre-order-based campaign is not a viable solution for many companies. So given the success of non-equity crowdfunding, it was inevitable that intermediaries doing capital raising would try to adopt the model and start thinking about how to do the same for equity crowdfunding. And so as I mentioned earlier, equity crowdfunding really originated from two perceived needs. From the startup perspective, there was a sense that startups lacked access to capital, and from the investor perspective, there was the growing sense that non-accredited investors, which make up 93% of the U.S. population, lacked access to early stage investment opportunities. But equity crowdfunding is essentially the internet coming to the capital formation industry. And when you think about what happens when the internet comes to any industry, when you consider what happened to the publishing industry, to the travel industry, the music industry, and increasingly the entire retail industry, what happens is buyers and sellers connect directly, middlemen are displaced, prices decrease as the industry becomes more efficient. And in the capital raising industry, the middlemen are the bankers, the finders, brokers, placement agents, the VC funds, venture capital funds, and all the others who for the last 80 years have played an indispensable role in connecting entrepreneurs with investors. In Title III crowdfunding, these actors will be largely displaced. So why hasn't equity crowdfunding been in existence before, or even in existence as long as non-equity crowdfunding? And in order to understand that, it's helpful to have just a little bit of a background in the securities law's impact on private offerings and capital raising in the private markets, and the historical impediments to raising capital. So essentially in the United States, any offer of securities must either be registered with the SEC, which is incredibly expensive and time-consuming. It can cost up to $2 million when all said and done to register with the SEC and go through the review process, or the alternative is to satisfy an exemption from registration with the SEC, and here the exemption that we're talking about is a private offering exemption. There are two general types of private offering exemptions. One is what's referred to as the statutory exemption because it appears in the statute, the Securities Act of 1933 in Section 4A2, which exempts from registration any sale of securities not involving any public offering. That's all it says. It's kind of vague, a little ambiguous, not a lot of specificity there. No one really knows how to comply with it except under general guidelines, general standards that have evolved over several decades from judicial decisions. And then there's another type of private offering exemption under Rule 506 promulgated by the SEC under the Securities Act. And it's referred to as a safe harbor because if you satisfy the specific requirements of Rule 506, you know you're in the safe harbor, you have the comfort of knowing that you have satisfied the exemption, and you can sleep well at night. What 506 allows you to do is that it allows you to sell to an unlimited number of accredited investors plus up to 35 non-accredited investors. Now, there's a lot of confusion about this aspect of private offerings because it's often said, and I may have said in the introduction to this presentation, that until now, until Title III crowdfunding, non-accredited investors were not allowed to invest in startups. They were not allowed to participate in private offerings. While that's effectively the case, technically that's not true because, as I just said, technically under Rule 506, you can sell to up to 35 non-accredited investors. The reason that non-accredited investors are thought to be shut out or previously shut out of investments in private companies in private offerings is because there's a built-in bias in Rule 506 in favor of only selling to accredited investors. It's a little complicated, but generally that bias manifests itself in an advantage in the disclosure area. Essentially, if you only sell to accredited investors, you do not have to satisfy the specific mandated disclosure obligations of Rule 506. So the vast majority, I would say 90% of private offerings that are done under Rule 506 are offered and sold to only accredited investors. Now, what is an accredited investor? For an individual, it's anyone who satisfies one of two possible financial tests. You don't have to satisfy both. If you satisfy one of these tests, you are deemed to be an accredited investor. There's an annual income test and a net worth test. The annual income test, you have to satisfy the annual income test, you have to earn at least $200,000 in each of the 2 previous years with a reasonable expectation of earning the same in the current year, or $300,000 jointly with your spouse in each of the last 2 years with a reasonable expectation of earning the same in the current year. The net worth test is $1 million, not including your primary residence. The last thing I'll say about the historical impediments is that it's largely believed that the biggest impediments to raising capital in the private markets is the prohibition on general solicitation that exists with Rule 506. To satisfy the exemption, you are prohibited or you were prohibited from engaging in any act of general advertising or general solicitation. So that means going on the internet, website, mass mailing, of course newspaper or TV ads. All that was prohibited. And particularly in the age of the internet, it was perceived as an incredible impediment to raising capital. You're denying companies of perhaps the greatest tool ever created to find otherwise qualified investors. And the second perceived impediment to raising capital, I'd say, is the accredited investor bias that I mentioned earlier. The notion that companies are limited to only selling stock to accredited investors, again, as a practical matter, because you are allowed to sell to up to 35 non-accredited investors, but because of the bias, the disclosure bias, most private offerings were only sold to accredited investors. So these impediments to raising capital led to a campaign of reformers, people advocating for capital markets reform, including myself, who through blogging, public speaking, petitioning the SEC, lobbying in Congress, sought to bring about reform of the rules associated with how companies can raise capital. And that all culminated in 2012 with a piece of legislation that really has the potential to revolutionize the capital markets industry. It's called the Jobs Act. Jobs, J-O-B-S, is really an acronym. And when you think about what was occurring in 2012, you'll understand how a transformative piece of legislation was able to get through Congress. So in 2012, we were undergoing an anemic recovery from the recession. There was an ongoing effort to try to reform the capital markets, and oh yes, there was an election. So people in Congress wanted the appearance, at least, of trying to do something about the high level of unemployment. And so in a stroke of marketing genius, I think, they came up with this acronym that spells out the word jobs. So the actual name of the legislation is the Jumpstart Our Business Startup Act, the acronym being JOBS Act. It has several segments to it, each one representing a different capital markets reform effort. Title I is not in this slide. Title I had to do with making it easier for smaller companies to go public. It was referred to as the IPO on-ramp. This presentation is really limited to private offerings, and specifically Title III. Title II of the JOBS Act is what is often referred to as accredited crowdfunding. So I mentioned earlier Rule 506, which is a safe harbor for private offerings, which historically prohibited any act of general solicitation. So what the what Congress essentially said was, you can keep your 506 offering if you like it. In other words, they didn't touch the 506 private offering exemption, but they created a new exemption, a new wrinkle on Rule 506, and they called it 506C. They renamed the traditional 506, which bans general solicitation, as 506B. And under this new method, under 506C, you're allowed to engage in general solicitation and advertising so long as you satisfy two requirements. One is that you only sell to accredited investors. Not a big deal here because, as I mentioned earlier, in traditional 506 private offerings, there's that built-in bias to only selling to accredited investors. So this new requirement in 506C to only sell to accredited investors, not that big of a deal, but here is the big deal. You have to take reasonable steps to verify that all your purchasers are in fact accredited. Historically, companies would want to know that they're only selling to accredited investors so that they don't have to satisfy the disclosure obligations, but the way they would determine accredited investor status is through this traditional 1- or 2-page questionnaire. You can ask the investor to just check off the box of why he is representing himself to be an accredited investor, and essentially you take that questionnaire and put it in your file and you're good to go. Now, I would never advise a client to be oblivious to obvious signs that someone is not an accredited investor, but basically the common practice was to have an investor just check off the box. Well, that will no longer fly with this new Rule 506C. That's just part of the bargain that Congress offered to be able to use this new private offering exemption and engage in general solicitation. So these reasonable steps to verify are generally understood to mean that you have to engage in more invasive steps to verify accredited investor status, including things like asking for brokerage statements, tax returns, perhaps a third-party representation, things like that. Title III is the real subject matter of this presentation. Title III is what I consider as true equity crowdfunding, in the sense that you can go online, use the internet, engage in general solicitation within certain limits, and sell to anybody, not just accredited investors, and without registering with the SEC. Title IV of the JOBS Act reformed an existing exemption called Regulation A, that was by far the least used exemption. In fact, the year before the Jobs Act was passed in 2012, there were only 6 Reg A deals in the entire country. The reason that no one used it is twofold. One is it had a $5 million cap, although I suspect that that in and of itself would not have been the major impediment. The real impediment to its use was that a Reg A offeror would have to get clearance from the state securities administrator of every state in which he wanted to sell securities. So no one ever used Reg A. It was crying out for reform, and that's what they did in Title IV of the Jobs Act. They did it in 2 different tiers. You can sell up to $20 million in any 12-month period in Tier 1. Tier 2, you can sell up to $50 million in any 12-month period. The trade-off here is that you have to comply with a whole bunch of investor protection safeguards, but the trade-off there is that if you are doing a Tier 2 offering and you comply with these enhanced investor protections, you do not have to go through the state securities process. State securities administrators are preempted under Tier 2. So I mentioned earlier that there are existing crowdfunding alternatives outside of Title III. And what I mean here is existing equity crowdfunding alternatives. And there are a few varieties of these. Again, crowdfunding is generically used to refer to any effort to raise capital online. And so the technology has really outpaced the regulators. And with the internet, with websites, with these internet portals, intermediaries have figured out ways to facilitate capital raising transactions and act as matchmakers between entrepreneurs, startups on the one hand and investors on the other. So the first type of equity crowdfunding alternative is what's referred to as accredited crowdfunding. There are 2 different varieties depending on whether the internet portal allows the companies to engage in general solicitation. Again, after the Jobs Act, there's now an alternative to Rule 506. So traditionally under what's referred to as 506B, you're prohibited from engaging in general solicitation, but you don't have to engage in these enhanced methods of accredited investor verification. An example of 506B is microventures. Microventures is a portal, a matchmaking portal. They specialize in technology companies. An example of the 506C that allows the companies to engage in general solicitation would be Circle Up. And then the other distinguishing characteristic of the internet portals that are doing accredited crowdfunding, again, these are crowdfunding transactions where the companies can only sell to accredited investors. These portals are also differentiated by their business model, and that business model in turn has consequences for the company itself. And I always caution clients when they are looking for internet portals to do a Rule 506 private offering on one of these portals to make sure they understand the business model, because it has a real consequence, most notably on their cap table. And let me explain that. So the first business model, one type of business model, is the broker-dealer model. In the broker-dealer model, the internet portal acts like a broker-dealer, so it just acts as a intermediary, a matchmaker between the company looking to raise capital and the investors. The investors invest directly in the companies, and if the broker-dealer is a registered broker-dealer, registered with the SEC, they can take a success, they get a percentage of the dollars raised. Not every portal is a registered broker-dealer, so most of the non-registered broker-dealers employ a different business model, and that's the investment fund model. Examples of the investment fund model would be Angel List, Our Crowd, Funders Club. This business model resembles the business model that's used by managers of VC funds and private equity funds. In this case, they'll set up a special purpose vehicle, usually in the form of an LLC, and the investors don't invest directly in the companies they're raising capital. Rather, they buy LLC interests in that special purpose vehicle. The portal acts as an advisor to that special purpose vehicle. They aggregate the investments in that vehicle, and then the vehicle invests in the private company. The advantage to the private company of this business model is that you only get one investor on your cap table, as opposed to the broker-dealer model where you can have potentially hundreds of investors on your cap table. And this has real ramifications, particularly down the road when you're considering raising funds from a venture capital fund. VCs like to invest in companies that have relatively clean cap tables, and they may shy away from a company that has a very complicated cap table. Another form of equity crowdfunding alternative is the registered crowdfunding. This is under Title IV of the Jobs Act that I talked about earlier, often referred to as Regulation A+. And I'll show you an example of that in a moment. There's also intrastate crowdfunding. Many states, probably half the states in the country, have adopted rules that allow companies to crowdfund, to sell online, but only to residents of that state, so it's obviously very limiting. And then there's foreign crowdfunding. Several countries have had equity crowdfunding for several years now, and the experience has been very good, both in terms of dollars raised and in the very low incidence of fraud, which is very encouraging. Here's one example of a non-equity crowdfunding campaign outside of Title III. This was a Reg A+ campaign. It was the first one to actually get SEC clearance. One thing I didn't mention about a Reg A+ offering is that you do have to file a stripped-down registration statement with the SEC and go through a review process with the SEC. Reg A+ allows companies to test the waters, essentially take the temperature of the investment community and see whether there's sufficient interest before committing to an offering. So here, this really neat company called Elio Motors that's designing a three-wheeled car that's going to sell for about $8,000 a pop. If you look at the numbers here, their funding goal was $25 million. They received indications of interest for $45 million. On that basis, they commenced the offering. They closed in February of this year at $17 million, so well south of the indications of interest, but close enough to their funding goal. They raised that $17 million from 6,000 investors, and 3 weeks later they were listed on the OTCQX, which is the highest of the 3 tiers of OTC. This is another milestone in equity crowdfunding. This was the first crowd-funded company to do an IPO. It's a company called Rewalk Robotics. Rewalk Robotics is a medical device company that develops wearable robotic exoskeletons for individuals with spinal cord injury. And it was very exciting. They went public last year, and then were listed and are listed on NASDAQ. So with that background, let's dive into the weeds of Title III crowdfunding. Again, this is part of the Jobs Act. There are lots of restrictions, both on the issuer, the company raising money through Title III crowdfunding, and on the intermediaries. And as I'll explain later, one of the distinguishing characteristics of a Title III crowdfunding campaign is that you must use an intermediary. So first and foremost, there are dollar limits during any rolling 12-month period. There are dollar limits on both the issuer and on every individual investor. Issuers are limited to only $1 million in any rolling 12-month period. An investor is limited based on or depending on his annual income or net worth. So if your annual income or net worth is less than $100,000, you can invest the greater of $2,000 or 5% of your annual income or net worth, whichever is less. If your annual income and net worth are both at least $100,000, you can invest the lesser of $100,000 or 10% of your annual income or net worth, whichever is less. This dollar cap on issuers is somewhat controversial. Only $1 million. I happen to think I was very upset about this initially. I still think it ought to be raised, but we actually have some data on equity crowdfunding campaigns that have been done abroad, and the data shows that the average offering size is only about $200,000 or $300,000. So maybe the $1 million cap is not so bad. There are other issues, other controversial aspects of Title III crowdfunding that are the subjects of reform efforts. This is one of them, but perhaps not as severe. The other thing I would say about the cap is that you can run concurrent offerings. So you can combine a Title III crowdfunding campaign with say a Rule 506B private offering. The only caveat is that you have to make sure that you satisfy the strict requirements of each type of offering. So if you're doing a 506 offering under 506B, of course you have to make sure you're not engaging in any general solicitation, and you have to show that if you do engage, say, in a 506C as your concurrent offering, where you're allowed to engage in advertising and general solicitation, you have to prove or be able to prove that none of your investors in the Title III crowdfunding campaign learned about the Title III offering through the advertising that took place in your 506C. There's some issuer qualification requirements. Not everybody can do a Title III crowdfunding. You have to be a U.S. company, so even Canadian companies can't do it. Indian companies, Chinese, Israeli companies, the usual suspects of startups raising capital in the United States, are shut out of Title III crowdfunding. You cannot be a public company. You can't be an investment company or a company that relies on a specific exemption from an investment company. This is also somewhat controversial. Remember, I spoke about the investment fund model that's used in accredited investor equity crowdfunding campaigns, where the portal sets up a special purpose vehicle. Well, that will not be allowed as of now in Title III crowdfunding. It is the subject of reform efforts. You also can't be a bad actor. The company cannot have engaged in any designated bad acts, or any of its officers or directors or major equity holders cannot have engaged in any designated bad acts. As I mentioned earlier, one of the distinguishing characteristics of Title III crowdfunding is that you must conduct your offering through a third-party online funding portal and only one funding portal per offering. And the reason for that is that they want everything channeled through this intermediary. The theory behind Title III crowdfunding is that through the wisdom of the crowd, if there's any fraud going on, when you have hundreds or thousands of eyes looking at a proposed offering, chances are it'll be sniffed out. You know, Title III crowdfunding was enormously controversial. Lots of people thought that this was an invitation for massive fraud. Again, this is the first time that non-accredited investors, as a practical matter, as a practical and legal matter, are able to invest in offerings like this. The immediate past chairman of the SEC, Mary Shapiro, who was the chairman of the SEC when the Jobs Act was created, was enacted, and when the SEC was tasked with promulgating rules to effectuate the Jobs Act, well, she was outspokenly against crowdfunding and made it abundantly clear that it was not going to be finalized, that the SEC would not pass final rules and it would not be legal on her watch. Her term ended shortly thereafter. The current SEC Commissioner, Mary Jo White, has proven to be much more receptive to Title III crowdfunding, but it remains very controversial because of at least the potential, the risk of fraud. And again, the theory here is that when you have the crowd, when you have hundreds and thousands of people looking at investment, that will sort of replace the registration, the disclosure premise of a public offering, an SEC-registered public offering. These intermediaries, by the way, have to be either a registered broker-dealer registered with the SEC and a member of FINRA, or, and this is one of the exciting aspects of Title III crowdfunding, the SEC created a whole new class of financial service intermediary that they call a funding portal. Funding portal has to be also registered with the SEC, but it's not as involved, not as burdensome a registration process as for broker-dealers, and they also have to be members of FINRA. There are some offering mechanics that have to be followed. Most of these are intended to protect investors. So, for example, investors can cancel their investment up to 48 hours before the closing of a Title III offering. These are all or nothing deals, so the companies have to declare a targeted amount. If they don't hit their targeted amount by the stated deadline, the investors get their money back. If the target is reached before that deadline, the company is allowed to have an early closing, but they have to give at least 5 days notice to investors. Also, if there's any material changes during the offering process, the issuer has to disclose those changes, and unless an investor reconfirms his investment intent, that investment would be canceled and his funds would be returned to him. In terms of the status of the securities that are offered and sold in Title III crowdfunding transactions, these are restricted securities as opposed to, say, Reg A plus securities that are not restricted securities and freely tradable. So in the case of Title III securities, there can be no transfers for 1 year. There's a 1-year holding period with certain narrow exceptions, those being to accredited investors, family, and also back to the issuer. Importantly, holders are not counted towards the trigger of number of shareholders that triggers SEC registration. That number historically was 500. If you had 500 shareholders of record, even if you had no intention of being an SEC reporting company, you had to register with the SEC, you became an SEC reporting company, and you had the requirement to file 10Ks, 10Qs, 8Ks, et cetera, et cetera. One of the things in the Jobs Act was that they lifted that threshold from 500 to 2,000 overall, or 500 non-accredited investors. Either one of those thresholds would trigger SEC registration. So if you remember, Facebook was essentially forced to register with the SEC. They had been private for a fairly long time. Mark Zuckerberg really had no intention of going public, but you can easily cross what used to be that 500 shareholder of record threshold when you have lots and lots of employees, and if you're a growing technology company, you tend to include some equity in your compensation packages. You can easily cross that 500 shareholder trigger. Facebook crossed that trigger and were forced to be an SEC reporting company. This was before the Jobs Act was passed in 2012. Facebook decided that if they're going to be an SEC reporting company anyway, they might as well do an IPO and raise a lot of capital in the public markets. So importantly, in Title III, the investors in a Title III offering are not counted towards that threshold that would trigger SEC registration, with one very important proviso, and that is that if you have more than $25 million in total assets, your purchasers in a Title III offering would be counted toward that trigger. I think this is a major issue, and this is also another source of capital markets reform effort that is going on right now that I'll get to at the end of this presentation. In terms of liability of issuers and intermediaries, investors have a rescission right. A rescission right is just a fancy term for the right to get your money back on certain happenings. Essentially, if there was a material misstatement or omission in the offering documents. And sort of a double whammy here. So for one thing, the standard for liability is very low. There are two types of standards in securities offerings, one that applies to public offerings and one that applies to private offerings under Rule 506. Under the former standard in public offerings, in IPOs and other SEC-registered public offerings, all a plaintiff has to show is that there was a material misstatement or omission, and then the burden of proof would be on the company to show that it either did not know at the time that it made the statement or the omission that it was a material misstatement, or that even if it had engaged in reasonable diligence efforts, it could not have known. So that burden of proof is determinative, usually, of how a case is going to end up. In a 506 offering, the burden of proof is on the plaintiff to show not just that there was a material misstatement, but that the company knew at the time, or that it would have known had the company engaged in reasonable diligence efforts. The second whammy is that the SEC, in a sort of a very noisy way in the final rules, said that it had considered whether or not to give an exemption to the intermediaries in Title III crowdfunding offerings, and has chosen not to. I think this is going to have a chilling effect on certain intermediaries. Not everyone, of course. There are several intermediaries that have gone through the registration process with the SEC and are doing Title III crowdfunding already. But already some intermediaries that have done crowdfunding either equity crowdfunding of other varieties or non-equity crowdfunding have announced that because of, or maybe they didn't specify this reason, but I suspect that their reluctance to enter into Title III crowdfunding is because of the liability issue. So there are disclosure obligations both in terms of the offering itself and post-offering. The offering itself, a company has to file with the SEC what's called a Form C, a disclosure document. Thankfully, there's no SEC approval. It's required, so there's no SEC review process. These offering documents that get filed with the SEC are going to look very similar to an offering memorandum, and they include sort of the usual suspects of categories of disclosure, like use of proceeds, of course, offering information, description of the business of the company, the management of the company, who are the primary beneficial owners, related party transactions. There are often in private companies, smaller companies, lots of transactions between the company and its management team, its large stockholders, and also probably one of the more important disclosure categories is risk factors. The financial information that has to go in these offering documents to get filed with the SEC have been somewhat controversial. Although I give a lot of credit to the SEC in general in passing the final rules, and in particular with respect to how they handle financial information, and I'll get to that in a moment, but essentially the level of financial information depends on the magnitude of the offering. So if you're offering $100,000 or less in the last 12 months, you only need to provide GAAP financials that are certified by your CEO, as well as information that appeared in your tax return. This is one way in which the SEC made it a little softer for companies, a little easier to comply. As originally proposed, companies would have had to actually file their tax returns, and there was a lot of opposition to that. If you're raising more than $100,000 and up to $500,000, the financial statements have to be reviewed by an independent public accountant. So that's a level of diligence by the accountants that's a little bit lower than a full-blown audit. And finally, if you're raising more than $500,000, the financial statements have to be audited by the public accountants. But what the SEC did in the final rules is they cut a break for first-time issuers under Title III. Those financial statements, your first time around, if you're raising more than $500,000, only have to be reviewed. If you otherwise have audited financial statements, you do have to include those. So once again, I applaud the SEC for taking sort of a more common sense approach here, because having audited financial statements for a startup could be very expensive. Continuing with disclosure obligations, companies during the offering have to file progress updates with the SEC at certain junctures. At the 50%, at the point at which it has raised 50% of its target, when it has reached its target, and when the subscriptions have exceeded the target, or if it closes the offering. In terms of ongoing disclosure obligations, the Title III crowdfunding issuer has to file on an annual basis an annual report. This is essentially the same information that's required in the offering statement, but excluding the offering specific information. The financial statements have to be only certified by your CEO, and you can terminate your disclosure obligations when you become an SEC reporting company, after you've filed one annual report and you have fewer than 300 stockholders, after 3 annual reports and you have assets not exceeding $10 million, or if you have repurchased, if the company has repurchased all of the crowdfunding securities that are outstanding, and of course if you liquidate or dissolve. Importantly, there are restrictions on advertising and promotion of a crowdfunding offering. Basically, the idea here is that they wanted to channel all communications onto the platform. There's an exception for so-called tombstone ads. Tombstone ads are what you used to see, say, in the Wall Street Journal and New York Times business section, announcing an offering. Very minimal information is allowed in these tombstone ads, just a statement that the issuer is conducting the offering, naming the intermediary, and a link to the offering page, the amount and the type of securities that are being offered, and also a description of the business. I think this is one of the biggest traps for the unwary, because I represent a lot of startups, and for a startup, self-promotion is like breathing, and it's in their nature to try to self-promote, and I think it'll be natural for entrepreneurs to approach Title III crowdfunding offerings the same way they approach selling their product, and they just have to be very careful in this regard. So far we've only been talking about requirements on the issuers. Now let's talk about requirements on intermediaries. And what I'll say about the requirements on intermediaries is that the idea here was the SEC wanted to deputize the intermediaries, that they should be sort of the adult in the room and give them a gatekeeping role. And so all of these requirements on intermediaries are intended to implement that gatekeeping function. So first and foremost, intermediaries are allowed to have a financial interest in the issuer, but not its officers and directors. This was a reform of the SEC, or an effort by the SEC to soften its rules from the original proposed rules, which would have banned any financial interest by intermediaries in a company in which they host a crowdfunding offering. The one proviso is that the securities received have to be solely in consideration of the services that are being provided by the intermediary, and they have to be the same securities as being offered in the offering. There are other measures to reduce the risk of fraud that the intermediary has to follow. Essentially, the intermediary has to have a reasonable basis for believing that the issuer is in compliance with its crowdfunding requirements, and is also either secured the services of a company to maintain its records, a transfer agent, or otherwise can prove that it's keeping accurate records of its security holders. And its intermediaries are required to deny access to issuers if it has a reasonable belief that the issuer either presents a risk of fraud, or if the issuer or any of its management team or 20% shareholders is subject to a bad actor disqualification. So when I think of bad actors, I think of Keanu Reeves or William Shatner, but when the SEC thinks of bad actors, it's thinking about this designated list of disqualifying bad acts, and if you engage in any of these bad acts, you cannot participate in a Title III crowdfunding offering. And so this requirement on the part of intermediaries is going to force them to have to conduct background checks on each issuer and each of their officers, directors, and 20% stockholders, and it just remains to be seen whether intermediaries will try and be successful in passing on the expense of that to the issuers. There's a requirement to have investors open an account with the intermediary, agree to have information delivered only through electronic means, through email. The intermediary is deputized as an educator. It's required to give educational materials about this kind of investing to its investors. And in terms of monitoring the educational component here, the intermediary is going to be required to get representations from the investors that they have review the educational materials and that they understand the risks associated with this type of investment. The issuer is required to ensure that the information is available on the SEC's website and to investors at least 21 days before any sale in the offering. So I mentioned earlier that the SEC will not review these filings, but I think that the fact that it's requiring filings with the SEC to be at least 21 days before an offering means that the SEC is probably going to take a look at these filings, and if they're woefully inadequate, I suspect that they're going to send bad boy letters to issuers. You know, who's responsible for monitoring the investor limits? Remember, the investor has its own cap in any rolling 12-month period. Well, it's the intermediary that has responsibility that no investor exceeds his investment cap. He's allowed to reasonably rely on an investor representation that an investor is in compliance with an investor limit, but that reliance has to be reasonable. So, for example, if an intermediary has two different portals and a particular investor is investing in offerings on each of those two different portals, and when you combine the amounts on the two different portals, that investor will exceed his personal cap, the intermediary is going to be expected to know that. So the intermediary is going to have some decent software to be able to monitor all this. Now, I mentioned earlier that that issuers can only advertise on the intermediary's portal. The way it's going to do that is that the intermediary is going to have to create these communication channels or chat rooms, which will allow investors to communicate with one another and with the issuer about the offering. The public will be allowed to see everything that goes on in the chat room, but only people who have opened accounts with that intermediary may post on the communication channel on the chat room. The intermediary itself is not allowed to participate in the chat rooms unless they're a registered broker-dealer. The reason for that is that the funding portals, the intermediaries that are not registered broker-dealers, because they're not registered broker-dealers, cannot engage in any investment advice, so they're not allowed to participate in the communications channels. And finally, they have to keep accurate records of all these chats. In terms of maintenance and transmission of funds, so the way that the offering will work on the portal is that investors, they transfer money to the portal during the offering period. Once the offering closes, if it closes, if the company hits the target at that point, funds are transferred to the issuer. If the company does not meet its target, then the funds are transferred back to the investor. Another thing that the funding portal, again, an intermediary that is not a registered broker-dealer, another thing that a funding portal is not allowed to do is to custody funds or securities. So during that offering period, it has to arrange with a third-party escrow agent to custody those funds. Some other restrictions on funding portals that I'll mention. I mentioned a couple of these already. It can't give investment advice. It's not allowed to solicit offers. It's not allowed to pay success fees to persons for soliciting investments. It also cannot receive success fees from companies that are raising capital. So it has to come up with creative ways to make money from all this. So these funding portals who are not registered broker-dealers will have to charge flat fees for other services like providing offering documents, providing services on the portal itself, arranging for third-party escrow services, et cetera, et cetera. And it also, as I mentioned earlier, it can't custody funds or securities. On the other hand, the advantage of being a funding portal and not a registered broker-dealer is that the funding portal does not have net capital requirements, and the funding portal's representatives do not have to pass the rigorous series exams like Series 7. So finally, and I apologize that I've run over a little bit, I want to talk about efforts to reform or fix some perceived defects in Title III crowdfunding. First and foremost, the issuer cap, which is currently at $1 million, is perceived to be relatively low, especially in comparison with other available alternatives. For example, under Reg A+, you can raise up to $50 million if you're doing a Tier 2 Reg A+ offering. Rule 506, private offering exemption, there is no limit whatsoever. You can raise an unlimited amount of funds. But then again, you cannot engage in a Rule 506B offering. You can't engage in any general solicitation. And in either Reg A+ or 506, any 506, you cannot, sorry, in Rule 506, you cannot sell to non-accredited investors, where you, of course, can sell to accredited investors in a Title III offering, so that you have that trade-off. I also think that that the issuer cap, in the big scheme of things, is not as big of an issue for the reasons that I stated earlier. These reform efforts, by the way, have manifested themselves in a piece of proposed legislation in Congress that was introduced about 3 months ago in the Financial Services Committee. It's called the Fixed Crowdfunding Act, which is pretty remarkable that the Fixed Crowdfunding Act, again, a piece of legislation designed to reform another piece of legislation that hadn't even gone into effect yet, because Title III crowdfunding only went live on May 16th. The Fixed Crowdfunding Act actually was introduced in Congress around March. So in addition to the issuer cap, the Fixed Crowdfunding Act is looking to fix the issue of portal liability. I mentioned earlier that the difficulty with this issue is that, first of all, you have a much lower threshold of culpability, of liability. Plaintiffs will only need to establish that there was a material misstatement or omission. The burden of proof will be on the issuer to prove that it didn't know at the time. And the second whammy is that liability will also be imposed on the portal. So the Fixed Crowdfunding Act will make clear that a portal can only be liable for misstatements or omissions of its own. It cannot be held liable for misstatements or omissions by the companies. And a plaintiff would have to prove knowledge. It would have to prove not just that the portal made a misstatement or omission, but that it knew at the time that it was a misstatement or omission. Section 12G registration exemption, this has to do with the trigger, the number of shareholders of record trigger for SEC registration. The issue here is what I mentioned earlier, that the proviso for the exemption is that a company not have $25 million of total assets, and I just think that that proviso is going to have a perverse incentive for companies not to do Title III crowdfunding at all. Not all companies, of course, but ambitious companies, companies that have great potential for growth. They will not want to have to be SEC reporting companies if they hit a threshold of $25 million in total assets. So that's also part of the reform legislation. In terms of special purpose vehicles, the reform legislation would make clear that funding portals can create special purpose vehicles for the purpose of aggregating investors into that special vehicle. And of course, the tremendous advantage for companies here will be that they'll only have one additional stockholder on their cap table as opposed to hundreds or potentially thousands of new shareholders on their cap table. And then finally, the Fixed Crowdfunding Act will allow companies to so-called test the waters. It'll allow companies before embarking on an offering to take the temperature of the investment community by soliciting indications of interest from investors before committing resources to a campaign. You know, the issue here is that securities offerings are expensive and risky without any guarantee that they'll generate enough investor interest. And so Congress and the SEC originally chose not to allow Title III issuers to test the waters. In other words, to solicit indications of interest from potential investors prior to filing the required disclosure documents with the SEC. So the concern was that allowing issuers to do so, to solicit indications of interest, would sort of facilitate unscrupulous companies to pretty much prime the market before any disclosure became publicly available, and without the protection of public disclosure. You know, issuers would be able to use selective disclosures or overly enthusiastic language to generate investor interest. But I think that you know, that is a little overkill. It's overly paternalistic, and so hopefully this effort to reform that aspect of Title III crowdfunding will be successful. And so with that, I will turn it back to Kathy and hopefully entertain some questions from the audience.
Thank you, Alon. We do have some questions, and I believe you may have answered or partially answered some of these, but I'll start from the top. What is considered a material change?
Great question. So the question is, what would be deemed to be a material change? I assume what the questioner is asking is, what would be a material change with respect to the offering that would require an offeror, an issuer, to have to file an amendment to its offering document. So certainly any material change in the business of the company, any change in the offering terms, any material change in the management of the company, any of those things would most certainly be deemed to be a material change that would require the filing of an amendment, and thus the opportunity for an investor to back out of an investment unless he reaffirms his investment intent.
Great, thank you. Next question, what are the typical fees associated with Title III, and are they all still due if the target is not reached?
Yeah, another great question that's on the minds of lots of entrepreneurs because when you are considering a Title III offering, you necessarily have to analyze it in the context of other available offering exemptions. So the question is, what are the typical fees? And that is going to be an evolving issue. What I could say is that there will be two fee models, one for intermediaries that are registered broker-dealers. Registered broker-dealers are allowed to take success fees, so they will undoubtedly charge a percentage of dollars raised. Non-registered broker-dealers, the so-called funding portals, are prohibited from taking success fees, so they're going to have to make up for it through various other fees. It's too early to tell what other fees are going to be charged by funding portals, let alone the amounts. But I suspect that there's going to be a lot of changes from what we see early on, certainly as the industry becomes more competitive. One thing that I've noticed is that intermediaries in the form of funding portals, the non-registered broker-dealers, have been slow to register with the SEC and become members of FINRA. Last I checked, there were only about a dozen funding portals that have gone through the SEC registration process. But it'll be very interesting to see how funding portals make a go out of it, and what sort of fees and the magnitude of fees that they charge.
When you say a percentage, do you have a range that is currently being used?
Well, again, Title III has only been live for less than a month. I haven't done a survey, but I would imagine that you could expect to see sort of the same range that you would find with a traditional placement agent or broker-dealer, outside of the online context. So maybe 3% on the low end and 7% on the higher end. I've seen rare cases where companies are charged a higher percentage by registered broker-dealers, and sometimes there's a sliding scale, the so-called Lehman model, where it's a function of dollars raised and gradations of dollars raised. But that's sort of the anticipated range.
And another question, should we expect that securities offered through Title III would be its own series and that no shares in that series would be available except through that path?
That's a great question. I think that what we're going to see in Title III offerings in terms of the securities being issued is a Series Seed type securities. Series Seed has been the trend to bridge the gap between a friends and family round and a VC round in terms of dollar amount, about $200,000 or $300,000 on the low end, and maybe like $1 million to $1.3 million on the high end. Anything lower than that, you're really structuring those deals as sort of loosely negotiated notes, and anything above that range, the $1.2, $1.3 million range, now you're talking about VC type money. So I think the Title III crowdfunding deals will see Series Seed type securities or just straight common stock. What I would advise companies to consider, I mentioned this earlier, as a way of dealing with a $1 million cap is to do concurrent offerings, and a way to minimize the potential for those offerings to be integrated, which is a concept in the securities laws where you think you're doing two separate offerings and complying with the exemption rules for each of those offerings, but the SEC will come in and say, no, 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 we're going to treat those two separate offerings as one, the result being that you've now blown your exemption. So I think one way to minimize the risk of that kind of integration is by having a unique security issued in your Title III offering, a different security issued in your concurrent offering.
And another question, will the offering documents typically reveal what any previous share prices have been? I assume this is a take it or leave it offering whereby the offer decides what a share value will be for this series.
Yeah, so that's a great question. So in terms of previous per share prices, that really goes toward valuation. And there isn't a requirement per se, but your financial statements will offer a window into what the company's valuation is. I would advise companies to put cautionary language in their offering documents saying that the offering price has been determined arbitrarily based on the company's perception of its own valuation. These deals, unlike other private offerings, which are negotiated with investors, these deals are not going to be negotiated by and large, and so the company will set its price per share. You'll have to compare the price per share against information in the financials, including, most importantly, the number of outstanding shares, and investors will have to make their own determination about valuation and whether the price per share is essentially a fair reflection of that valuation. Now, I'm sorry, was there a second part of that question?
It was, I assume this is a take it or leave it offering whereby the offerer decides what a share value will be for the series.
Yeah, so I guess I addressed that by mentioning that these, the Title III crowdfunding deals are typically not going to be negotiated deals. So in that sense, it will be a take it or leave it. Even more so, by the way, now that I think about it, even more so than an IPO, because an IPO at least has the influence of the underwriter. The underwriter will help set the price. The underwriter will have a sense of what the market will bear, and so the issuer isn't free to just arbitrarily set the price. In this case, even the intermediary will not play a similar role, an analogous role to an underwriter determining what the market will bear. So I think that it will be largely a take it or leave it proposition.
Great. Do we have any other questions? I'm not seeing any come in, so we can go ahead and wrap up today's webinar. Alon, thank you so much for taking the time to present to us today. Thank you, everybody, for joining us.